The price of gold is often used as a benchmark for market stress. However, with the extreme stress in the current environment, gold has not done what many have been expecting and risen to, or, as a surprise to some, moved beyond the record highs in excess of 1,900 an ounce set 9 years ago. So what about the current environment for precious metals? Small cap fund manager Angelos Damaskos runs the Junior Gold Fund, and he joins us now on the phone. Angelos, it's good to talk to you. In your most recent fund update, you do highlight the fact that gold in many currencies other than US dollars, where gold is commonly priced, is at record highs as a function of the currency markets. But let's start by asking you, if we can, on your thoughts on the current environment.
Yes, Jeremy, first of all, thank you very much for inviting me back. I think we live in unprecedented times and circumstances at the moment. During the course of last year, if you recall in our previous discussions, we were concerned about the macroeconomic outlook for the global economy, that there was a possibility for a recession and a slowdown in growth, plus the possible risk from the extreme leverage in the system. And this is why we believe a lot of investors started moving into safe havens last year, particularly in the second half, and pushed the price of gold and silver, for that matter, to 6-year highs. But towards the end of the year, in December, we were hit, or rather the market and the economy were hit, and humanity for that matter, by this dreadful pandemic that is now spreading around the world, and is causing extreme stress, and most certainly is going to push the global economy into a recession in the near term. This has caused a lot of unrest in the market. Clearly, there is a lot of liquidity crunch. People have been trying to get out of risk assets and therefore liquidating positions. I draw a parallel to the conditions that we've all experienced during the 2008 liquidity crisis, when Lehman Brothers went bankrupt. It was declared bankrupt in September 15, 2008, and from between August 29 and November 20, 2008, the S&P 500 fell by 41%. Whereas gold actually retained its value better than any other class and only fell by about 10%. However, the gold equities, influenced by the market and being equities and having a direct correlation with the equity markets with a so-called beta factor, dropped by 46%. So there is a very clear parallel to what is happening today. We saw gold only last week reach a 6-year high of $1,700 per ounce. Today it trades at around $1,470 or so. So it's about 13% below the high reached only last week. So I think the market is showing a very clear parallel of an extremely distressed situation where there are lots of sellers and very few buyers.
Going back as well to compare where we are at the moment in history, 10, 12 years ago to the financial crisis, do you think, in all honesty, has gold lost any of the magic that it had 10 or 11 years ago? Of course, since gold was at those peaks, we've had the introduction of cryptocurrencies. And I know that some people believe that the space occupied by the likes of Bitcoin and Ether and Ripple have stolen some of the people that would otherwise have invested into the gold and silver markets.
Yes, I think there was a little bit of a feeling along those lines 1 or 2 years ago. But I think cryptocurrencies have actually lost their shine completely, and they have been proven for what they really are, which is a worthless medium of exchange, if you like, or speculation for that matter. And for example, in the current conditions, you see all the cryptocurrencies have fallen way more than 50%. Way more than gold, for example, has corrected. So it proves that there are no safe havens at all, remotely. Whereas gold still retains pole position, so to speak, among the safe haven assets, and it's acting very well under the circumstances. When markets are extremely stressed, we have to bear in mind that investors are desperate to tap at any liquidity they have at their disposal. There will be margin calls in this market. There will be other situations where cash is needed desperately. Therefore, any investor that has even a small exposure or investment into gold might be seeking to liquidate that and gain the cash to help with the rest of the situation. So I think gold is behaving how we would expect it to do this time around. The question is, what will it do once, hopefully, humanity gets control of this pandemic situation and the falls in the market, the dramatic falls in the market are arrested? We also have to bear in mind that today's market has been hit by another major event, which is the total collapse of oil prices. And that is by the decision taken by OPEC when they disagreed with Russia on cutting production to control the drop in demand. They have actually started a price war with Russia in order to regain market share. So the total collapse of oil prices is a huge stress on the market, even though it might be beneficial for the global economic growth. It is a huge short-term liquidity event for the market that exacerbates the situation and exacerbates the currency crunch for all asset classes.
I wonder if I can take a look at an expanded part of your portfolio. The Junior Gold Fund, I know, also invests in silver miners. The gold to silver ratio recently has expanded out to a record. I believe it's now around about 117. In other words, gold is more than 117 times the price of silver. What's causing this, other than the fact that silver has failed to keep up with gold in terms of the overall price?
Well, that is precisely the reason for the widening of that ratio. Silver is naturally, historically, rather much more volatile than gold. And it's a much smaller, much narrower market that can be influenced by short-term events much more aggressively than gold. We see now, particularly yesterday, silver had a huge drop of around 13-14% in a single day, and it's taken the price down to 12.50 or so, which is where it was trading at the beginning of last year, well before the latest gold price rally started. So it is peculiar and very interesting to see silver collapsing so dramatically under the currently stressed liquidity situations. But again, looking back at what happened in 2008, something similar happened to silver. And then, of course, in 2009 and 2010, it recovered very aggressively and massively outperformed gold as the 30-year sort of gold-silver ratio restored back to around the 66 price level. 66 times level, rather, sorry.
In the last 3 years, your fund has, looking at your most recent sheet, it's underperformed the FTSE Gold Mines Index, which is your benchmark. What is it about the fund that's brought this about particularly?
Well, our fund focuses on the smaller capitalization, earlier stage companies. So we focus on the growth part of the industry rather than the producers and the mature companies. So what has happened is this segment of the market naturally suffers much more than the rest when liquidity is short, because they are much smaller, less liquid companies, and therefore they tend to suffer more when there are no buyers around and there are some possible for sellers. The fund massively outperformed the market, the sector, and the gold price in 2016 when we saw the previous recovery rally. And it did so again back in 2009 when we started the fund, when obviously we were following a very strong market for gold shares and the gold price that reached 1927 by late 2011. So for the last, after the recovery rally of 2016, again, investors did not want to focus on the smaller capitalization companies for liquidity reasons and instead focus on the mid and larger cap producers, which performed relatively well last year. I think the sector was up about 40-45% during the course of 2019. But most people agree that they should have done a lot better given the rise in the gold price. The smaller companies, frustratingly enough, underperformed during the course of 2019 and started catching up towards the end of 2019 and the beginning of this year. They caught up significantly, but now suffering poor liquidity conditions. Nevertheless, they are broadly performing in line with the other funds. So I think, again, it shows that there is a very big band of investors who are very interested in gold mining companies, can see the rise in the gold price and believe that the gold price will recover and possibly go much higher than where we are now under the circumstances, and therefore are willing to have an exposure in the sector, including the large, the mid, and the small caps.
Okay, let's just take a look at some of your picks. I want to start, if I can, though, with a stock that I think from your portfolio sticks out to me because it's been the subject of a bid recently. Cardinal Resources. I'm interested in this because I think it's interesting to see what's happened with the share price of Cardinal Resources. Explain what's going on.
Well, we have been shareholders in Cardinal for a couple of years, 3 years now, I believe. We followed the company and the management team from the early stages of developing a very significant project called Namdini in northwestern Ghana in Africa. And it has proven to be a significant resource. It is a very attractive project, certainly world-class. More than 5 million ounces of gold in proven reserves that is now rapidly progressing to construction of the mine, financing and construction of the mine, and possibly producing gold in the next 2 years. So it's a world-class deposit that has been, or I imagine would have been viewed by most bigger players as a potential attractive growth project. And yesterday, there was an unsolicited and sort of unexplained approach, if you like, by North Gold, which is a Russian-controlled gold mining group with operations in North Africa, but primarily in Russia and former CIS countries, including Kazakhstan, that has put an offer, has entered into an option agreement first to acquire 19% of the shares from Goldfields, that was the previous holder, but has also put an offer to acquire the shares that it does not control through that option agreement at 46 cents per share. Now, we believe as shareholders that this grossly undervalues this project. The company should be worth a lot more, should be worth much closer to $1 Australian per share. But obviously, the currently stressed market conditions make it possible for people who, with cash and ability to use their paper, to move in and buy assets at very attractive valuations. So let's see what the board thinks of this approach and whether they will try to negotiate and improve the value. But my feeling is that anything below 70 cents per share grossly undervalues this project, and hopefully the management team will be able to negotiate something, if not encourage another big company to come forward and put an alternative offer.
Okay, just a few moments left. A couple of other shares you're looking at?
Well, our portfolio is full of prospective situations. I think in this environment, most of our holdings are prospective takeover targets because the industry suffers from reserves, from low reserve life, from reducing grades, and therefore even the largest producing companies need to find growth projects to replenish their pipeline. Two situations that I think are extremely attractive in our portfolios, and they are both in our top 10 positions. One is Ascot Resources, that is developing a fast-producing resource in northwest British Columbia in Canada that holds approximately 1.8 million ounces of gold and 6.8 million ounces of silver in the measured and indicated categories. And the other one is called Integra Resources, which is developing also a fast-producing resource in Idaho in USA that holds approximately 1.5 million ounces of gold and 96 million ounces of silver in the measured and indicated category. So things like that are likely to be potentially involved in corporate activity in an environment where gold and silver recover their strength and go higher in the next year or so. And the larger companies are pressed to enhance their growth pipeline, improve their prospects going forward at the moment they produce more than they find.
Angelos, we'll leave it there, but thank you so much indeed for your time. It's a pleasure to talk to you on the phone as we look at this drawdown in the price of gold, but interestingly, some of those smaller cap companies worth watching. It's a pleasure talking to you.
Thank you, Jeremy.
That's Angelos Damaskos, who runs the Junior Gold Fund.